For decades, when you thought of Indian banking, you thought of HDFC Bank. It was the gold standard, right? A true titan. For investors, it was like the North Star, a symbol of perfect execution and nonstop growth. But wow, has that conversation changed recently?
So the big question on everyone's mind, and probably yours too, is how? How did a bank that literally seemed flawless suddenly find itself smack dab in the middle of a storm? Well, let's get into it and unpack exactly what happened.
It all started with this one single event in late March 2026 that was just a total shocker. The bank's stock crashed, and not by a little, a staggering 9% in a single day. And that was just the start of a slide that wiped out billions. For a rock-solid stock like HDFC Bank, that was just unheard of. Okay, so to really get what went wrong, we first have to understand how they got so much right for so long. HDFC Bank's dominance wasn't an accident. They built an absolute fortress. And that success, well, it all stood on just a few incredibly strong principles. Really, it all comes down to three things, three pillars that made them practically unstoppable. First, this thing called the Casa Fortress. Second, their credit discipline was just ironclad, almost legendary. And third, unmatched consistency. I mean, they were like a machine.
So what on earth is this CASA fortress I'm talking about? Well, CASA just stands for current account and savings account. Think about it. It's the money you and I keep in the bank. HDFC Bank became absolute masters at getting millions of people to park their money with them. And why does that matter? Because that money is super cheap for the bank. It gave them a massive pool of low-cost funds to lend out, creating these huge profit margins that nobody else could really touch.
And that brings us to their second pillar, that ironclad credit discipline. Just look at this number. Remember back in the 2010s when a lot of other banks were getting burned by giving out huge, risky corporate loans? HDFC kind of sidestepped all that. They focused on regular people, on retail lending. And the result? Their gross non-performing assets, basically their bad loans, were always incredibly low. I mean, 1.33%, that's not just good, that's world-class.
And then pillar number 3, consistency. I mean, really try to wrap your head around this. For almost 20 years straight, under its founder, the bank delivered 20% profit growth. Not every year, every single quarter. It was like a Swiss watch, a machine, and that's what earned them that bulletproof trust from investors and that premium price tag on their stock. People were happy to pay more because it was just flawless. So you have this incredible fortress, right? Built on these 3 solid pillars. It seems invincible. So what could possibly go wrong? Well, let's jump back to that March 2026 shock and find out exactly where the first cracks in that fortress started to show.
And when it happened fast. Like, incredibly fast. On March 19th, boom, the chairman, Atanu Chakrabarty, resigns. And not in 2 weeks, effective immediately. The market panicked. That very same day, the stock just plummeted 9%. And it wasn't a one-day thing. The selling just kept going, pushing the stock to a fresh 52-week low. But here's the thing. It wasn't just the resignation itself that sent shockwaves through the market. Nope. It was the reason he gave. This is a quote from his resignation letter. He said there were happenings and practices over the last 2 years that did not align with my personal values and ethics. Wow. Okay, for a bank that built its entire reputation, its entire brand, on trust and pristine governance, that one word, ethics, was like a lightning bolt. It was a red flag of the highest order. The market immediately started thinking the worst. Is there a huge governance problem? A massive fight between the board and the CEO? All bets were off. So, look, the chairman's resignation, that was absolutely the trigger. But the gunpowder? That was already piled up and waiting for a spark. If you look past the drama and the headlines, the bank's own financials were already showing a giant under. Some serious strain, especially after that massive merger with its parent company, HDFC LT. And this chart right here tells a big part of that story. We're looking at something called net interest margin, or NIM. The easiest way to think about it is it's the bank's core profitability. It's the spread they make between the interest they earn on loans and what they pay for deposits. Before the merger, a really healthy 4.1%. After the merger, it's gotten squeezed down to 3.7%. Now, that might not sound like a lot, but for a bank this size, that's a huge deal. It's a clear sign that profits are under pressure. And here's a few reasons why that's happening. The merger suddenly jacked up their loan-to-deposit ratio to 110%. Basically, they had more loans going out the door than they had deposits coming in. To balance the books, they had to jump into this intense deposit war with other banks, basically offering higher interest rates to get people's cash. That's expensive, and it forced them to slow down their lending. On top of all that, you've got whispers of a culture clash. The fast-moving bank merging with the more traditional parent company.
So that kind of brings us right up to today. You've got a leadership crisis colliding with these real financial headwinds. It's a tough spot. So what's next? Let's take a look at the path forward and the big questions facing this banking giant. And this really gets to the heart of the dilemma for investors right now. It's a classic two-sided story. The bulls, the optimists, they'll tell you, hey, the stock is the cheapest it's been in 15 years, and they have this huge opportunity to sell more stuff to their 10 core customers. But the bears, the pessimists, they're worried that this cultural friction could lead to more execs walking out the door, and that this margin pressure from the deposit war could stick around for a lot longer than anyone thinks.
But here's the thing, despite all the drama and the turmoil, when you look under the hood at the core numbers, the fortress itself still seems fundamentally strong. I mean, their asset quality is still top-notch, their capital cushion is exceptionally strong at around 20%, and yeah, like we said, the stock itself is, by historical standards, pretty darn cheap right now. So when you boil it all down, the foundation of the bank, that's not really what's in question here. The fortress is still standing. The real debate, the multi-billion-dollar question for investors, is all about the speed of the recovery. How quickly can it get back to being its old self? And that leaves us with the one big final question. This bank was literally built on a special DNA of discipline and flawless execution. Today, the challenge isn't about their business model. It's about leadership and post-merger integration. So, will that core DNA, the very thing that made them great, be strong enough to win out over these very real, very current strains? Well, that's what the entire market is waiting to see.